How defensive do you want to be in this market right now?
You do not want to be defensive in this market. The idea of an economy that's continuing to grow in 2018, of course, only 3 months left, but 2019, 20, probably 21, would suggest you want to be more cyclically positioned or in terms of better growth. And the way to think about that would be certainly more technology as a key part of the portfolio. And that's, I think, consistent with the fact it's your best growth in terms of earnings growth. These are the companies that are investing most in their own opportunity set in terms of capital spending, and that's likely to drive future growth as well. And that's a strategy that we've been focusing on with many portfolio managers. The companies who are taking their cash flow and directing it affirmatively into investing for the future. That's both research and development dollars as well as capital spending, growth capex, as opposed to maintenance capex.
Yeah, we actually have a bar chart that we borrowed from one of your notes showing that, which shows that, in fact, capex is growing, although buybacks are growing much more than capex is. They're still spending. There it is right there, you see.
In the last 20 years, 19 of the 20 years, you've had capex as the #1 priority spending for corporate America. The one exception to that was 2007. And this year is likely to be another anomalous experience where buybacks will be the #1 use of cash. That's a situation partly reflecting the new tax law that had companies repatriating some of their cash and using it to buy back stock. But also, it's a fact that the opportunity set is still very robust. There's lots of cash flow with companies having their cash flow, for example, has grown 36% this year. So you've got sales up around 11%. You have earnings up 25%, but cash flow from operations growing around 35%, 36%, which means there's a high-quality problem. What do you do with this incremental dollars that a lot of it's being allocated to repurchasing shares, which is one reason why you want to be focusing on a market that's generally moving higher in line with the economy.
But there is a push and pull there, right? So that's sort of the push, but the pull is going to be trade. And you yourself, you have a great chart that shows earnings estimates and where you think they'll be. And then once you account for trade, the earnings growth, not so much. Can you walk us through what you see in these different scenarios based on your current forecast?
So if you look at this exhibit, which we just, as you indicated, has published this report, our baseline forecast for S&P 500 earnings per share in 2019 is $170 a share, 170. And we think about what is the scenario of various tariff or trade tensions that may take place. For example, all of the just announced on Monday or implemented on Monday, the $200 billion trade with China. This shows a scenario that if you apply a certain tariff rate there, you could have earnings come down perhaps at 159. So put that in context. This year, you'll have earnings per share for the S&P 500 around $159. Baseline forecast is earnings grow 7%, and a more dire scenario would be no earnings growth. And so if you're paying 17 times multiple, almost now 18 times multiple for 7% earnings growth, what multiple would you pay for 0% earnings growth? Arguably less than that. And so if you're looking at, say, 15 times, the scenario would be something in the vicinity of 2,600 in the S&P 500. Now, my baseline forecast is 2,850 for this year and 3,000 at the end of next year. And this would tell you a downside scenario, maybe 10% lower, if the trade war was to persist.
David, you said that certainly for the rest of 18, into 19, 20, you said even in 21, you're seeing growth. That's further out than many people are willing to look. In fact, a lot of people are saying maybe the last half of 19, even to 20, we're going to see a slowdown. What gives you that vantage point, and how would it change your investment decision? So the discussion of when is the next downturn going to take place is a much debated point in most client meetings. The modal forecast from Goldman Sachs Economics is economic expansion decelerating in 2019, 20, 21. Now, the probability of a recession will grow as we go over time, but that is not the baseline forecast at the current time. So that's still pretty far out, if you think that's more than almost 3 years out right now. The baseline forecast as a portfolio manager is to think about what is the likely trajectory of economic activity in 2019 and 20, because the market for next year will start pricing in the growth in 2020. And my argument would be consumer confidence is still extremely high. Very strong. 70% of the U.S. economy is composed of that. Small business optimism, one of the highest it's been in 40 years. And corporates are buying back a lot of stock, and they're also at the same time investing a lot in their to grow their businesses. And those are consistent with economic expansion and, more importantly, earnings growth. And so you don't need you need a lot of activity. And where do you get the most of that growth is going to be in the form of the technology, where you get the better growth.